Today, are there still more falls ahead? Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and property news with a distinctively Australian flavour. Today I'm joined again by Harry Dent, author and economist. Hi Harry.
Hi Martin, good to be back.
Well, thank you very much for spending some more time with us. Your last post was a riot. We've got a lot of people who watch that show, one of my most popular shows, but also a lot of follow-up questions. So I thought perhaps what we could do today is to just go a little deeper into some of the thematics that we explored last time. And of course, things have changed a little bit since then, with the markets looking a little bit more positive. But I think your thesis would be, and one of the questions people asked is, it's still going to fall further.
You know, I think the odds barely favor that. A week ago, I would have said almost a certainty. When looking back at the past first bubble crashes in 2000, 2002 with the last tech bubble, and then, of course, the ultimate comparison today, from my point of view, 29 to 32, a real full bubble burst and deleveraging, that there should be one more wave down. Yeah, and we look for typically 40% or a little more first crash in 2.5 months. And of course, we're right. We're still away from that 2-month level. And then by the end of April, 2.5 months. So I think there's two scenarios here. One is that because the rally was strong on Monday, it is a higher chance that we did bottom on March 23rd. That was the bottom in the U.S. It was probably close to that in Australia. The markets are all down 30-some%. And we've been down anywhere from 32% on the NASDAQ to 44% on the small caps, and the more typical S&P 500, 35%. So the pattern would look better if we had one more wave down. There's usually a first wave down, a rebound, a sharper, harder third wave in the middle, which we clearly saw a rebound, which we're now in. And then one more wave down. But what did happen, and this is something that fits with something I've been warning people, is that this virus thing, I said, by early April, by April 7th, Italy's, and that's literally on Tuesday, clear that it's really decelerating. And then shortly after that, Spain and the rest of Europe. And then maybe a week after that, or a little more, the US, or particularly New York, our epicenter. That is happening. And that was the reason the markets started to rally on Friday, but they really jumped on Monday because the markets did get, oh my gosh, it does not look like it's just going to take over the world and eat everything like a cancer cell, So that does increase the odds, but I wouldn't be surprised. I mean, one thing that could happen, Africa's locking down now. They don't have a lot, but they're getting it. And man, that kills China's supply chain, and China's trying to come back and supply the world, and that hurts the world. So we could still have things like that. We could also have, everybody's guessing it. Do we have 15% sudden unemployment in Australia, the US, or 20? It could still be worse than we think. And I wouldn't be surprised at that, because I went through the hurricane in Puerto Rico, which was literally like a really hard 3-month shock. I had to leave the country. 15% of the population left the country, and only half of those came back. And only 10, 20% of the businesses went under. It kind of never came back. So it's a U recovery, but this shock could be more. So we'll have to see. But I do think this will resolve soon. At this point, I would say the markets may continue in this rebound a little higher into early next week, and then we could see one more wave down. If they can last much past that, or not see a big wave down after that, then I think we're out of the woods. But either way, it's still, the next phase is we are going to see a multi-month rebound, particularly towards the US election. And that gives people a better chance to get out at better places and time to prepare and learn from this crash what investments did well. And it's the US Treasury bonds, #1. It's the US currency, #1 in currencies. And even the darn AAA corporates did not do that well, because when you get a shock like this, AAA credit doesn't matter. You're a cruise ship line or an airline or a big hotel company or big retail company, and your sales are down 50 to 80%, AAA doesn't do you any damn good.
Yeah, very interesting. And look, one of the big differences between the 1930s and now is that last time around, in that big crunch, basically they didn't put a lot of money in. They actually did things to make the economic situation worse. Whereas now we've got this massive amount of stimulus in the system. The Fed's done massive amounts for Europe. Everywhere you look, Japan announced overnight, nearly a trillion dollar stimulus too. So do you think the amount of money that's being thrown in from all corners of the planet, as it were, to support the economic system and the financial system is part of the reason why we're also seeing prices perhaps going more positive?
Well, yeah, that's part. I mean, in the 30s, it was a little more old-fashioned. Of course, it's always low rates when you have a downturn like that. But they actually raised rates temporarily. I think it was 1930, and caused a little shock to the system when it was already in trouble. And they did do some quantitative easing. I didn't realize this till later, but it was after that in the 32, towards the end of it. They're doing it full blast up front. Here's the problem I have, Martin, why these central bankers are going to lose this battle. I've said it from the end. When it comes to Mother Nature and a bunch of douchebag academic central bankers, who are you going to bet on? This is Mother Nature coming back and saying, take that, you guys. I mean, can this virus be stopped by printing money, like a stock crash, which they can stop in its tracks, like the Great Depression in 2008, which was coming just like in 1930, stopped it in its tracks. And the shock is sudden. It's not like, oh, you start to slow down and one thing, rolls into the next and makes it worse. It's kind of like a staircase thing. No, this is a sudden shock. And we're still going to find out in the next month or two how big a shock and how long does it last. I mean, the hurricane was over in 36 hours here, and the place was dysfunctional for 3 months here. I had to leave, come back. It was a U-shaped recovery to come back. Why? Puerto Rican's economy was already weak from a 12-year recession after the pharmaceutical industry's incentives were stopped, and that stopped growing jobs, and that was their main thing. Our economy is weak because these damn central bankers, year after year after year, especially since late 2008, early 2000, have printed more and more money, stopped any deleveraging, any getting rid of zombie banks, bad debts, bad companies, reallocating workers from dying industries to new, all the things that a good recession and even a depression at more extreme does to make you more healthy. We are extremely unhealthy with high real estate prices, unaffordable in Australia and the US, but worse for Australia there. And so much net worth concentrated in Australia in real estate. And so much debt, 90 more trillions been added around the world since the GFC. And we were so much over in debt coming into the GFC, you can't even compare it to the roaring 20s or any debt bubble or financial asset bubble in history. And this is so global. So that's the Achilles heel here. Yes, central bankers have pumped all the way into this and are pumping everything right at the beginning instead of waiting until it's bad. But you know what they're fighting, Martin? The inevitable deleveraging of 330 trillion freaking dollar monster of financial assets globally that they created artificially above normal. In the US, it's 125 trillion, and we are more than double the highest valuations of financial assets versus GDP since World War II. More than double, have to come down to 50% just to get back to the peaks in last cycles, nevertheless, reality. And the same in the world. That 60 trillion reset in the US, which will happen, is 3 times our GDP, and globally from 330 down to, I'm estimating, 160 trillion, reasonable by past depression standards. 2 times global GDP. That's what the Federal Reserve is fighting. Can they print enough money to offset $160 trillion globally coming at them like this last crash? We just had, I'd say, up to 20 trillion in stocks disappear in a couple of weeks. And if you count other assets, probably in junk bonds and other stuff, probably 30 or 40 trillion in weeks. They couldn't react fast enough. They didn't print that much money to offset it. So why are they going to do it when it happens in the future? So that's the problem. people think, well, since the banks are so accommodative, central banks, but they've already been so accommodative, they created this monster that's bigger than them. Here's the formula. They put in $20 trillion approximately globally in the last 11 years directly into financial assets, not into the bank lending to multiply money in the old-fashioned way that creates productive assets, hopefully. No, they put it in financial assets, blew up, and created probably extra 150 trillion assets, way more than they printed. So the monster they've created is bigger than them. So now they're going to have to up the ante. They're going to have to print $100 trillion, $150 trillion in the next few years. Do you think the world will let these douchebags do that? My answer is no. The stock market already laughed at them on Monday the 16th after the biggest stimulus announcement, 10 times anything the Fed has done short term before. The markets laughed and went down 3,000 points, 15% I think that was, in one day. Welcome to the new world. The central banks have created a monster, blown their wad. Now they don't have enough to throw at it, and they wouldn't have the credibility. Let's say the Federal Reserve, we go in another crash later this year, which I see. We get out of this one. And then they say, well, now we're going to print $50 trillion in 2021. Don't you think the alarms will go off and people start going, what's wrong with you people, and rioting in the streets? I think so at some point. The market already laughed at them for the first time. The market loves this stimulus, loves crack. Give us more crack, more money to boost us up. Has nothing to do. My spending wave, the most accurate indicator I've had back to World War II, and it's worked for my entire, so the last 2 decades, unbelievably, says the market's 120% overvalued, not 20 or 30% versus GDP. This is not sustainable. They can't beat this bubble. They've created Frankenstein. They're the mad scientists, and Frankenstein's going to kick their asses, and they're going to look like the stupidest people in history. Stupidest.
Did you see the FIDC post that I was reading a little while ago? They looked back at the 1930s and concluded that actually being less clear about individual banks' balance sheets actually helped protect some of the banks in the 1930s. So they're actually proposing effectively being less clear now about the balance sheets of the major banks in the US, but they're actually more concerned not about retail deposits because there's a deposit insurance scheme in the US, but corporates who are potentially at risk at taking huge amounts of liquidity out of the banking system. So they want to actually keep it quiet and then stop a level of disclosure that currently exists today.
Well, after the GFC, when we came back, 2 things happened. Corporations were the ones that borrowed the most, and largely to buy back their own stocks, which is totally unproductive, gambling speculation with their shareholders' cash flow, given by grace by central banks because they would have been in a depression and been sucking wind anyway. So that's what happened. In emerging countries, the emerging countries went on a borrowing binge because now we made US dollars and euros, but mostly US dollars, cheap by printing all this money and forcing down rates. So they went on a binge, and they're the least credit worthy. So again, they've only created a bigger monster. The consumer debt is still high, but not as out of whack, and it's more out of whack in Australia and Canada today because of your beautiful, wonderful, loving high real estate prices that you guys in Australia have fallen in love with to your demise. I've been warning about this. Real estate bubble is not good for your kids, and any future generation is not good for your economy and your country's competitiveness. So get over it and let this thing come down. And the best way you can profit from it is sell your home now, or sell your excess real estate you don't need now, because you will not be able to sell it to anybody a year from now. Real estate clams up. Stocks, when I'm wrong, I can sell 10, 20% down in a minute. Real estate, you can't do that.
Yeah, well, certainly in Australia, the market's already frozen pretty much because they've banned auctions. There's very, very low levels of auction clearances. The real estate sector is still talking it up, saying, we can still do this online, and we can do virtual walkarounds and things. But all of my surveys are showing that the momentum is easing. And interestingly, I've also now got information showing the number of forced sales are rising quite quickly. So there are people being forced to sell, partly because they can't meet their mortgage repayments, partly because they're trying to get out, particularly investors. About 8% of investors, property investors, according to my research, are trying to get out before the thing crashes so they can see the writing on the wall, right? So it's a question of if you're going to get out quick, because, things are going to drop, and they're going to drop quite strongly.
That's right. Especially real estate. Again, I'm even telling people now, I knew most people wouldn't believe me that, and I used to quote Baron Rothschild in the late 1800s, early 1900s, said, Baron, what is the secret to your grand success? He's supposedly the most wealthy person in the world back then. He said, I always sold a bit early. I knew people wouldn't do that. I knew they'd wait until the crash started. And then when it happened, you couldn't even say, what does it do? It goes limit down every night, night after night. And then it gets crossed, and then it goes right back down the next night. You can hardly even get out in a crash that extreme. But I tell people, hey, that's okay. This crash is either over or about to be over literally this month. It won't last this month. If it does go down, it'll probably only go a little lower because the worst is already in. The VIX, everything's telling me in the middle wave is usually the worst. It was in 29. It was in 2000, the first crash. And there is so much stimulus put in just recently sitting. The markets actually got it quicker than I thought they would. We were getting it 2 weeks ago. I'm looking at the S-curve saying, why are people looking at the total cases? That's not what you look at, idiots. If you want to see the S-curve, you got to look at the daily cases, because you can tell when you hit the 50-yard line, and then you can project the goal line very accurately and know when this thing is going to tame down. And we already knew that was going to be late first week for Italy and Spain, and then the next week fully for the rest of Europe, and then with that week or next, the U.S. We could tell that early on while everybody was saying, oh, there's going to be 200,000 deaths in the United States only if we do everything perfect. Baloney. There might be 50, maybe. The worst model I see on the S-curve says 96,000. I don't believe that, because they're using New York as a projection for other states, and New York is the most dense city by far in one of the coldest areas. You can't compare Dallas to New York. And so I think they're overstating, but the markets they got it on Monday. They literally got it because oil, they were supposed to be a talk between the Saudis and Russians to try to prop up oil. They canceled that. Normally the markets would have been down again on Monday. Nope, the markets literally did wake up. So the experts, obviously Andrew Cuomo, I figured out, he got the right experts. He got people like you and I who know how to analyze data rather than just extrapolate. That's what most economists do. The head of the Fed, only guy that endorsed me in the United States years ago, he was the head of the Dallas Fed for many years. He said economists are just closet extrapolators. And something a nutless monkey could do. You take a trend and just project in the future. That's, things are exponential and cyclical. You have to understand that to make accurate forecasts. And economists are straight line extrapolators. So when they get in a strong, exponential trend like a virus taking over the world, like cancer tries to take over your body, that's another exponential trend that you have to fight hard with chemo, a war to stop, like a lockdown. They just project it's going to go up forever like that. That's crazy. Nothing goes up forever exponentially like that. It does long term, but it doesn't do it at one time. It goes up exponentially and then down. And so the markets are getting that. So I think there is a chance we've set in a bottom. I still suspect we got one more wave down. I'm looking at the markets. I think they'll go a little higher into early next week, and they ought to start turning down sharply there if they're going to make one more new low. If they don't do there, then I'm saying, we're just in this long now bear market rebound, which we've already seen the best of. The bear market rebounds, most of it happens in the first week. Same thing. If you look at these patterns, there's no surprises here. First big crash, extended rebound, but it's a bear market rebound, and most of that happens in the first week or two, and then it's just da-da-da-da-da-da, and then when everybody thinks everything's okay, bam, the big one comes in that last 2.5 years. This is totally predictable pattern. You just have to understand what happens when debts and financial asset bubbles deleverage, and nobody understands that because, the last time it happened, other than the tech wreck, which was less impactful because it was in a boom, was 1929 to 32. There's not a person alive, and the few that are have Alzheimer's. Nobody's going to remember that and tell you what happened and see it clear. You and I look at history. That's how we figure this stuff out. History's crystal clear on this. And the number one trend, I've told people for years, and I only figured out 7 years ago what caused it. Every 90 years since the stock exchanges were created, stocks became a major part of the economy. Every 90 years, big bubble, big burst, depression, big bubble. So 1837 to 42, bam. Nobody saw that coming. That was the greatest depression in U.S. history and globally, but particularly hit the U.S. Midwest expansion. Central banks, what was the government doing? Giving away darn near free land and financing it to any idiot with low interest rates. Oh, you think you get a bubble out of that in speculation? Yeah. You think it burst? Yeah, and it did. 29 to 32. The bottoms are exactly 90 years apart, and the next bottom, and I've been projecting this, Martin, since I started my indicators in the 80s. 40-year cycle, ironclad. Next bottom will be late 2022. That is going to be exactly in that 90-year cycle. It started a teeny late, only months from 29 peak, but I expect the next bottom around the end of 2022, and it's going to be way, way lower than this. And if you don't get out of the way of it and listen to the few people that understand what a bubble is, you're dead. You're not going to have any wealth to take advantage of the next global boom. You're not going to be able to retire. Your business will not survive if it doesn't hunker down ahead of it. And if it does hunker down, guess what? This is not to destroy everything. It's to get rid of the crap. Get rid of the weak, the bad banks, the zombie loans, the inefficient companies doing the wrong thing, the over-in-debt companies. If you hunker down, you are going to survive, and you're going to have 2 to 3 times the market share coming out of this because your competition is going to disappear, a lot of it. So this is huge opportunity. If you see it, huge threat to your wealth and well-being if you don't. And I always know. I get people calling me every day, friends and stuff, past subscribers. Oh, damn, Harry, I didn't listen to you. Well, I know that. But at least listen now. There's stage 2 and 3 coming. The rebound. Hey, you may be down 40 recently. You could be down 15% by the time this rebound. Oh, that's not so bad. And then if you prepare for the next one, oh, my God, you're going to have 2 years to gain and protect against it. And so just take this first one as the lesson. What did well? It's going to be similar next time. The same things I said, except the high-grade corporate bonds and munis did not hold up well because the virus destroyed everything. So if the virus comes next time, which I think it may not, I think at least the developed world is going to be ready for it next time once we get rid of it here near term. It may go in the third world, and that'll be more dangerous. But if it's not the virus, then then you'll be able to buy treasuries and AAA corporates and high-grade bonds and stuff and make money, not from the interest, some from the interest, which is as good as dividends in most cases, but more from the deflation play. Somebody says, interest rates are so low on the U.S. Treasury bonds. Well, they went from, 1.3% down to 0.5%. Those Treasury bonds went up in value 24% when that happened, even from low rates. Long-term bonds that don't default and don't have default risk push their rates up radically, like Italy's getting, and of course, and Greece got last time, and junk bonds always get, will benefit from deflation. But does real estate benefit from deflation? No. Do stocks? No. Commodities? No. Gold doesn't benefit from deflation, damn it. It just holds up better because of its crisis value. It doesn't benefit from deflation either, and never has.
Yeah, very interesting. So one of the questions I got from the previous post was specifically your point about gold, because you still hold to your view that ultimately gold is probably going to be lower rather than higher. Yeah. And it's because of your deflationary rather than inflationary view of the future, correct?
Right. I'm like, what don't? And I like gold bugs better than normal economists because at least they know you can't prosper by excessive debt, which is always do in history until we get our asses kicked. But why can't they get that the very debt and financial asset bubbles they're describing always end one way, except a few rare circumstances, mostly in third world countries, and the Weimar Republic after World War I, where they not only were totally bankrupt from losing a major war, but on top of that, reparations. So they had to print money to pay bills. See, that's not happening today, Martin. In Venezuela, it's happening. They have hyperinflation. That happens when you're printing money to pay bills you can't afford, not when you're printing money to boost up financial assets. What happens after that is those bubbles burst and destroy that money times 10 that you created. So that's what's happening here. It's different. And if you see that, then there's nothing but money to be made from.
Yeah, absolutely. And it's about having the right perspective, isn't it? Because, there are still people who say, well, look, I've got my gold and, the prices are reasonable at the moment. And so therefore, relative to what else is going on at the moment, it looks pretty good. But if you take a slightly longer view, and as you say, in the deflationary world, then effectively the answer's less good.
Yeah. First of all, gold correlates with one thing and one thing only back 400 years as far as they can track it. Inflation, not deflation. Okay? Crisis too, but crisis is way less. A deflationary crisis is not good for gold. An inflationary crisis, the reason the gold bugs are up and down, the last major long-term recession and crisis we had was the late 60s and 70s and early 80s. Gold was beautiful. It was the safe haven. It's not this time. Now, here's gold playbook. Now, we've seen it twice. So get it this time. In 2008, because the crisis is building, and then people say, oh, well, the bank, central bank's going to have to stimulate and print money. Gold went up in the early stages of 2008 when the economy went down and commodities went down, except for oil, which was being pumped up by hedge funds and stuff. But gold went up. And then when things fell apart and you really got the downturn in the deflationary part, it went down 33% overnight. Silver, 50%. It's not the safe haven. Okay, what did it do here? It was going up into the stock market top mid-February. It went up for the first, I think, 4 days, 3-4%. And guess what it did? Went running to mommy again, down 10%. Gold ended up down 7%. Now, hey, is that better than holding stocks? Yeah. Not as good as treasury bonds, up 24%. Not as good as cash, holding its value 100%. So gold is not the worst place to be. And in the commodity, but 2 crashes in a row, it does well in the early stages, thinking there's going to be an inflationary outcome. And in reality, it's always deflationary. And when did gold really collapse? After it did rally, when they printed money in late 2008, early 2009. It collapsed when Japan tripled their money printing in late 2012, early 2013, and inflation kept going down. It kind of killed the argument, oh, duh, governments print money and that causes inflation and that's going to cause hyperinflation. No, they're causing asset price inflation, not consumer inflation, because it's not going to consumers. It's not going into spending in bank accounts and corporate investment. It's going into financial speculation, which creates bubbles. You think debt deleveraging is bad, like the 30s. That was mostly what that was. Financial asset bubbles burst way faster than debt deleverages, and they've created way more. In fact, what did I figure? Oh, compared to the monetary base increase, by the Federal Reserve in the U.S. only, financial assets went up 20 times that much. Money supply only went 2.3 times. GDP less than that. They didn't stimulate the economy. They created the Frankenstein bubble of all time and try to stop a bubble from bursting when it gets extreme. And at some point, whether Australia likes it or not, real estate will deleverage even without a crisis, because the rate has been going up in the last 30 years. If it does it just another 5 or 10 years, you'll have to be a billionaire to buy a freaking house on the bay in Sydney, damn it. Does it end there? What does it take? Bubbles destroy themselves. So don't confuse brains with a bull market, especially a bubble. Bubbles will defeat themselves, but here, thank God, we have the perfect trigger, the virus that does not respond at all to money printing.
I love it.
Love it. Couldn't happen to a nicer bunch of douchebag central bankers.
Now, Harry, there was one other question which came up quite a lot from the previous show. You've got your models of 90 years and, the 21 years and the 40 years and, all wonderfully correlated and working. Then you've got this sort of trigger, right? And the question was, well, how could you predict a trigger, which was effectively, a medical emergency that came out of nowhere, that swamped the whole world? How does that work in the context of cyclical analysis?
Well, actually, again, my co-author, Andy Pangioli in London, he got this a little more as it's happening, but he has an 18-year virus cycle. There was AIDS, SARS, and this, like 18 and a half years apart. So if you were looking for that, now I wasn't looking for a virus to be the trigger. I was looking for a big developer in China to blow up, or the shale, big shale companies in the United States to blow up with this oil war. All it takes, the subprime crisis was not that big a deal when you add it all up. It triggered a worldwide crisis because the economy was so over in debt and so weak and so stretched, and bubbles were so high. So I was looking for something else. But even when this happens, like if somebody had been saying, and I think this Fossey guy who's advising Trump now, who's overly pessimistic from my point of view, but he warned 2 years ago when Trump was getting first coming off, he said, there's a high chance of a pandemic in the next few years. I forgot his reasoning or whatever. It wasn't an 18-year cycle, but Andy puts this right on an 18-year cycle. But the difference is, that 18-year cycle does not compare to this 90-year cycle. This is when it comes to stocks and financial assets, real estate and stocks, this 90-year is the king cycle. It's two 45-year technology cycles that build on each other. Bubbles come from the exponential growth of technologies more than demographics. The demographic boom of 42 to 68 had no bubbles, no bubble burst, no correction over 20% until the boom started to wind down. And then it went to 20, to 30, to 50, but so this is a bubble era, and all it took was a trigger. But yes, if somebody had told me, oh, for some reason, there's a real chance of a pandemic, well, Andy could have pulled out. I didn't have that cycle. Andy and I have about 80% cycles overlap, but I found this 90-year cycle. I always knew it from the stock chart long term. I didn't know it was technology cycles that caused it until I started working with Andy in 2008. And he said, Gann, who was the master cycle forecaster in the early 1900s and roaring 20s and stuff, he said, Gann always says 45 and 90-year cycles are critical. And then I started looking back at my research, and I saw steamships, 1875, bubble peak crash. Railroads, 1920, final bubble crash when cars came along. And then 65, the automobile thing had saturated and then, crashed. And then, of course, the internet I'd been projecting for years would peak around 2010 and saturate. And so I'm like, oh, my God, this is an exact 45-year cycle. And the big bubbles, hey, steamships and railroads together built global transformation in transportation. Well, electricity, electrical appliances, and then computers and the internet built the next big revolution. It took both of them. The big cycles come every 90 years. So if you're not on alert every 90 years, then you're just not looking at history. And this is the most obvious cycle of all the ones I have. And thank God, I don't like having a cycle. I can explain demographics. I can explain geopolitics. The cycles have. It took me a while to be able to explain this 90-year cycle. Now I can explain it. And it's happening in spades, and it's happening right according to plan. Whether the virus caused it or something else, same 40-ish% crash in 2.5 months, right in the middle of that now, just about over it or already over it. And then we will get a rebound for 3-5 months, maybe longer the election. And then we'll get a 2 or 2+ year downturn that's more grudging. And you finally get the deleveraging and detox there. And that's where all the setup. Now here, I'm going to give you one more thing. I don't know if I said this last time. One of my favorite charts. It shows from the top in 1929, the last major bubble and depression. From the top of that to the end of the depression in 1941, okay? We measure cumulative GDP from the top with a big crash and a very strong rebound and compare it to the 2007 top into now with a muted crash, but extremely muted, weak, wimpy rebound, we are actually 11 years after that top, we're better off in 1940 than we were in 2018. I got to update. And we haven't seen the worst yet since we put off this crisis. The worst is going to come in the next 2 to 3 years. So we're going to end up worse than the Great Depression because instead of dealing with the crisis, because they let it go down, we did deleverage a lot. You don't deleverage government debt, you deleverage the private debt, but people don't understand that the private debt is typically 3 times or more the government debt. And deleverages rapidly. Governments have to support the economy, and governments can print money if they have to pay their bills, or pay their interest. Private debt deleverages, and that's what makes the economy lighter, nimble, ready to rebound again and more productive. And because you weed out all the unproductive crap. We are sustaining a load of crap, and Japan's been doing it now for 30 years. So do you think Japan kind of proves that constantly stimulating your way out and not deleveraging debt, which they never did, works? 30 years later, Japan's still on their ass. Real estate still down 60 to 70% residential. Stocks bounced about halfway back and are getting ready to turn down and make new lows again 30 freaking years later. They didn't go through winter, so they don't get spring. If that doesn't prove this doesn't work, I don't know what does. But people will get it after everybody else falls. All you and I can do, Martin, is warn the 1% or whatever we reach, people who actually think and look at logic instead of being high on the drug, the financial drugs, and loving their real estate. If you love your real estate, you're a freaking idiot. That's my message to you, Australia. Love it because Australia is great. Love it because it's great real estate. But don't fall in love with the bubble or you're an idiot. If you don't see that, you're blind. And you are going to get your ass kicked. And so is the banking system in Australia that has 75% exposure to real estate. Our U.S. doesn't have that for a banking system. U.S. net worth, 30% exposure, 30% in real estate. Yours is 67%. You're going to get your ass kicked by real estate, not your demographics. That's your strong card. Your real estate bubble is your weakest card, and that's what people in Australia are most in love with. Not smart.
Harry, I love talking to you because you make it so clear. Now, we should just highlight there are a couple of opportunities for people to interact with you further on this, because obviously there's a limit to what we can actually cover on the DFA channel. So do you want to just talk about what you're planning to do?
Yeah. First of all, around summer, June or July, we're launching a new mutual fund that can navigate these seasons, up and down, winter to spring, whatever. The first fund ever to do this. And we're starting in Australia because I found a firm and a guy named Andrew Stewart that understands what I'm doing because he went on tour with us and he brought this up. So we're building a list of people. We already have a couple thousand. Okay, we're going to let you guys know first when we're ready to come out with this fund so you can move and be in it. The sooner you get in the fund, the better. And so you go to GoCo, G-O-K-O, group.com/Dent. That's to sign up to be notified about the new fund. And we're having an event, a free webinar on Thursday the 9th at noon. And you go to harrydent.com.au to register for that. It's free. We're trying to tell as many people in Australia in this confusing time where things are going so they don't do the wrong thing. So sign up for that free webinar. You can't go wrong with that.
Harry, I appreciate your time today. Thank you very much once again for sharing your insights with DFA and on the audience here. Always great to talk, and I'm sure we'll catch up again down the track.
Yeah, thank you, Martin.
Thanks for that. Keep safe. Bye.